Have you ever just stared at a stock chart and all you see is this? Jagged, random line going up and down. Yeah, most of us have. But what if I told you that line isn't random at all? It's actually a story. It's a real-time record of this huge, global battle between millions of people, all driven by hope, by fear, and of course, by cold hard cash. In this explainer, we're not just going to look at the chart, we're going to learn how to actually read the story that's written inside it.
So, here's how we're going to do it. We're going to peel back the market, layer by layer. First, we'll get into its core secret, the simple mechanic that makes it all tick. Then, we'll talk about the messy human psychology that throws a wrench in the works. After that, we'll actually learn the language of the price charts, zoom out to the big picture with inflation, and finally, we'll bring it all home with a practical tool you can use to control your own trades. All right, let's get into it.
First up, the absolute foundation of everything, the market's simple secret. Seriously, this is the engine that powers it all. It doesn't matter if we're talking about ancient Greeks trying to corner the market on olive presses or today's super fast trading algorithms, the same principle applies.
So let's just start with the most basic question there is. I mean, if you strip away all the noise, all the news headlines, all the fancy indicators, what is the one single force that actually decides the price of, well, anything?
To get that answer, let's just picture a simple fruit stand. You've got one person who wants to buy a peach and one vendor who's selling one. The vendor says, "Hey, that'll be $1." Now, if the buyer agrees and hands over the dollar, a price has just been set. But if he says no thanks and walks away, there's no transaction, no price. It's that moment of agreement that's what creates the price.
Okay, but that balance is super fragile. What happens if we add more sellers? So you've still got our one buyer, but now there are 5 different vendors, all trying to sell him a peach. All of a sudden, who has the power? The buyer does, right? He can just say, well, that guy over there will sell it to me for 90 cents. This is what we call a buyer's market. And you know what happens? The price has to come down.
Now let's flip that on its head. One vendor, one perfect peach left. But now there are 5 different people who all desperately want it. Well, the power has completely shifted. The seller is in the driver's seat. He can start raising the price, making those buyers bid against each other. That is a seller's market, and the price is going up.
And that little story perfectly illustrates the engine of every single market on Earth, supply and demand. That's the secret. That's it. Every price move you see on a chart, whether it's a tiny tick up or a massive crash, at its absolute core, it is just a picture of the shifting balance between how much stuff is for sale and how many people want to buy it. So here's the kicker. That supply and demand engine, it's simple, it's mechanical, but the people operating it, well, we're not. We are complicated, emotional, and, let's be honest, often predictably irrational. And that brings us to our second layer, the human element that gums up the gears. You know, Mark Twain just nailed it with this one. The details of what happens in the market are always changing. You get new companies, new technologies, but the human reactions, they are incredibly consistent. The same patterns of greed and fear that drove the Dutch tulip craze back in the 1600s, they rhyme with what we saw in the dot-com bubble, the 2008 housing crisis, and yeah, even the crypto mania we've seen recently.
It's almost like every investor is fighting a battle between 2 different markets at the same time. You've got the logical market, the one we think we trade in, where decisions are based on spreadsheets and data and careful analysis. And then there's the emotional market, which is where we actually live. This is the one that gets hijacked by the fear of missing out, or FOMO, by greed for those quick profits, and that powerful, almost primal instinct to just follow the crowd.
The legendary investor Benjamin Graham came up with the perfect way to think about this. He called it the parable of Mr. Market. So imagine you have a business partner, and he is moody. Every single day he shows up. Some days he's euphoric, totally giddy, and he offers to buy your shares from you at a ridiculously high price. Other days he's in a full-blown panic, offering to sell you his shares for pennies on the dollar. Now here's the key. You are totally free to just ignore him. The goal isn't to guess his mood, it's to patiently wait for his moments of despair and take advantage of the bargains he offers you.
So this constant battle, right, between the simple logic of supply and demand and the wild emotions of Mr. Market, well, it gets recorded every second of every day. And it creates a visual story for us, a price chart. So now, let's learn how to speak its language.
Honestly, this is the most important mental shift you can make. A price chart isn't just a bunch of data points. It's a conversation. Every single point on that line represents a moment in time where millions of buyers and sellers all around the world collectively said, yes, we agree on that price. It's a map of millions of yes and no decisions.
So when you see a price fall and then bounce off the same level over and over again, what you're seeing is something called support. This isn't magic, it's market memory. People remember that price. The folks who bought there before made some money, so they're happy to buy there again. And the people who missed out before, they see a second chance to get in. All of that creates this big pool of demand that supports the price, like a floor. It's a spot where Mr. Market's panic creates a bargain that people just can't pass up.
And the opposite of that is resistance. This is like a price ceiling, and it's also formed by that same market memory. It's a level where buyers who got in at a lower price look at their profits and say, you know what, this is a good place to sell. At the same time, other people who think the stock is getting too expensive might start selling too. This creates a wall of supply that the price resists breaking through. It's where Mr. Market's euphoria starts to look a little too crazy for the smart money. Now, when buyers are consistently more powerful than sellers, they don't just hold the line at old support levels, they push right through those old resistance ceilings and they turn them into new support floors. This creates this beautiful staircase effect of higher highs and higher lows. That's an uptrend. And a downtrend is just the opposite story. It's a sad staircase down where sellers are in control and they're turning old support floors into new resistance ceilings.
But what if the very thing we use to measure all these prices, the dollar itself, is constantly changing in value? It's time to zoom out, way out. We need to look at the invisible force that's pushing and pulling on the entire system, and that is the inflation engine.
To really get this, let's forget about stocks for just a minute. Let's talk about something simple, like a gallon of milk. Let's say a year ago, it cost you exactly $4.
And today, you go to the store, and that exact same gallon of milk now costs you $4.12. It's a small increase, sure, but it raises a really important question. I mean, think about it. Is that milk suddenly 12 cents more nutritious? Is it tastier? Did its actual value somehow go up? Or is it way more likely that the milk is exactly the same and the dollars you're using to buy it have just lost a little bit of their power?
And that right there is exactly what inflation is. When the supply of money in the system goes up faster than the supply of actual goods and services, you just have more dollars chasing the same amount of stuff. It's why you always hear people say that stocks can be a hedge against inflation, because as the value of your cash slowly goes down, the price of real assets, like owning a piece of a company, tends to rise just to keep up.
Okay, we've gone from the tiny details all the way out to the biggest macro picture. Now, let's bring it right back to you, the individual investor. Knowing all this stuff is great, but how do you actually act on it with any kind of precision? Well, that's where you can use the market's own rules to your advantage. This is all about controlling your trades. Well, let's talk about the stop limit order. This one sounds complicated and it confuses a lot of people, but it's actually super simple if you think of it as a two-part command. Okay, step one is the trigger. Your stop price, let's say it's $51, is just an activation switch. Your order literally does nothing. It just sits there until the stock price first touches that $51 trigger. Then, and only then, does step two happen, the order. The moment that trigger is hit, your real order, your limit order, is sent to the market. And this order has your rule attached to it. It says, okay, buy me the stock, but I absolutely refuse to pay more than, say, $51.50 for it. It's perfect for a trader who says, look, I only want to buy this if it proves it's strong enough to break a key level, but I'm not going to chase it to the moon if it explodes higher. It lets you automate your strategy and takes the emotion right out of the decision. So there you have it. We've gone all the way from a simple peach vendor to the complex mind of Mr. Market. We've learned the language of support and resistance, felt the big invisible tide of inflation, and we've ended with the precision of a trading order. Every single chart tells a story of supply, demand, and raw human emotion. The only question left is, now that you know how to read the language, what story are you going to read next?